This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk, and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Stephen Arnold, thanks very much for coming on Talk Your Book, especially considering the circumstances. So thanks for taking the time, and I thought maybe it'd be a good place to start if you'd talked us through Aorus and what your philosophy is there.
Well, thanks for having us on the show, Chris. Aorus was a business we founded a bit more than 2 years ago. We're a long-only global equity manager. A few distinctive things about us as a business is, firstly, we're concentrated. We own a maximum of 15 companies globally. We think of ourselves as business owners, so we don't short stocks. We don't think about timing the market. We think about creating wealth for clients and protecting capital through participating in the wealth creation of wonderful businesses. And thirdly, we try and keep things as simple as possible. So our too hard basket, if you like, is much, much larger than the other one.
And what stock do you want to talk about today?
But we talk about a wonderful business we own based in the United States called Cintas.
And what's their business model? What do they do?
Cintas is America's largest uniform rental company. So the way to think about that business is if your business employs people who wear uniforms, that could be a hospital, it could be a manufacturing site, it could be a restaurant, it could be a hotel, then an alternative to acquiring uniforms for those employees would be to rent them. And Cintas is the largest by far in what they do, and their model would, their driver would appear at your work site once a week with 5 clean uniforms per employee, tops and bottoms. It'll cost you about $1.50 US per employee per day, and it'll ensure that they remain looking fantastic. While they're wearing those uniforms, Cintas is responsible for cleaning them, maintaining them, replacing them when needed. And then while they're there, the van driver might say, look, you've got an entrance mat outside the front of your workplace. It might say Hilton Hotels. It might say something else. Lots of people walk over it. How about we include that as part of the rental program? We can replace it, clean it, maintain it for you. So that's also looking fantastic. So there are other services that they can include as well.
And it doesn't take you long when you start investigating Cintas to see that workplace culture is something they really pride themselves on. What is it about their culture in particular that appeals to you?
Well, Chris, you've highlighted what the company themselves call their greatest asset. In fact, I thought a way of introducing this is to show this book here. Which,
it's our first prop ever on Talk Your Book, Stephen, so it's a milestone for us.
Oh, great. Well, I haven't bought a picture of a van, but this is something that they regard as far more important than their vans, and that's their employee book. So they give this to every new employee. The book was written 50 years ago. It's only been updated 4 times. And it's not only about the culture, it's about the whole of Cintas' history, and the history of the business is it was created by the great-grandfather of the current CEO. The origins of the company go back to 1929 when they were acquiring used rags from households during the Great Depression and recycling them. So that's a great institutional story and memory, if you like, that they go to great efforts to preserve, the sense of where we've come from. And then the book is 85 pages. It's not just a set of waffly statements that go on the kitchen wall and no one pays attention to. It's something that they put a lot of effort into ensuring that it's relevant. Now, I first visited Cintas in Ohio about 15 years ago, and the very first thing the CFO did before I'd even sit down was give me that book. And I visited them again about 12 months ago, and the same thing happened. The very first thing that the CFO gave me was the copy of the book that I have there. So it shows you that not only that they think it's important, but they go to great efforts to make sure that it's relevant to the way the business operates. And so what's the culture is, it's a very competitive culture, that they know that in order to create opportunities for their employees, they've got to grow. It's a very ethical company, and then they know that their reputation is very valuable. They know it's a very client-centric organisation. They keep their customers on average for 20 years. They've got a retention rate of 95%. So while they win a lot of new customers, they keep their existing customers for a long time, and they're able to sell more services to their existing customers. The customer-facing part of the organisation is the van drivers, and so these are not unimportant people. These are the face of the company. So management spend some days per year sitting in the front of the cab with the van drivers to make sure that they experience what the van drivers are experiencing, understand the issues, think about ways that they can help make the van drivers' life more efficient and more productive. and experience their problems and show them how much the head office cares, if you like, about their workday. So it's an organisation where culture is the greatest asset. They go to great efforts to preserve it, make it relevant, and it's been a very, very successful company.
So almost every company would say that culture is really important to them, and almost every investor would say the companies they invest in, they want to have a good culture. What sort of data points, either qualitative or quantitative, can point to that culture? Obviously, that customer churn rate being only 5% is one that really stands out. Are there any sort of quantitative other data points you look for that are clues that the company is doing what it says around company culture?
Well, I think over a history of decades, then a few things that was where the rubber meets the road, if you like. Well, your employee retention, your customer retention, your ability to grow, and your ability to grow profitably. Another way of dimensioning it, if you like, is our own interactions with the company now. There was a point in time during late 2019 where a US short seller said publicly, look, we've bet against Cintas, and here's why. And as periodically happens, they have a very long presentation of all the bad things that they think about a particular company. Now, we thought, look, first, it's important that we can talk to the company, but recognising that in a time like this, it might be difficult to get access to them. So to our surprise, the CFO was actually exchanging emails with me over the weekend, making himself available to have a conversation at a time when they were being attacked publicly. So that sense of transparency and a willingness to engage and have a sensible, open conversation about issues perceived or otherwise, we thought was a great highlight of a culture of integrity, transparency, honesty, openness. And that's what we look for when we make any acquisition or an investment in a business, is that, can we engage with them in a way that we think is honest and open?
And talk to me about some of the valuation metrics around free cash flow, return on invested capital, or any others that you feel are important.
We like to own businesses that are a leader in their market, where leadership matters. Now, this is a great example of where being the leader in their market is a huge advantage. So in any given geography, if they have more customers per mile, then the efficiency in their asset base is much better than the smaller guy. They have big laundry facilities that they launder these uniforms, and they've got a lot of trucks driving around. So the number of customers per mile, if you like, is a good way to think about that. So while they're the largest nationally, in almost every postcode in America, they're also the largest. And so the scale is a huge asset for the business. And the way that's reflected is how profitable is their asset base. And if we compare it to their largest publicly traded competitor, A, their profit margin is higher, and 2, their asset efficiency is higher. And the way that comes together is that for every dollar of assets, they generate twice as much dollars of earnings as their nearest listed competitor. And so as they grow and reinvest capital to grow, that reinvested dollar of capital is twice as productive as for their smaller competitor. So that's the key. When we like to own these wealth-creating businesses that as they grow, they earn high returns on capital. And as they grow, that size advantage gets reinforced, and the gap between them and the nearest peers widens, not closes. And then next year, that gap or that size muscle is even stronger. And so Cintas, those features are very much at work. So we value cash earnings, not accounting earnings. And in the case of Cintas, because the asset base is so productive, every dollar of accounting earnings, if you like, is equivalent to a dollar of cash. When we think about what is that dollar of cash worth, well, we put a lot of emphasis on risk premium, if you like, or quality. And so we're willing to ascribe a high premium valuation to Cintas, not only because of its growth characteristics that we think are durable, but also the quality and risk characteristics. So that all washes together into a valuation that we think is materially above where the business trades today.
So that's like resource analysts often talk about the companies being in the lowest quartile for production. It's sort of that similar sort of philosophy, obviously, but for an industrial business instead.
Yeah, we want the best business in an industry.
Yeah.
The industry is rational, and oftentimes it's not the highest growing industry, but it's where the strongest player can generate growth well above GDP, and there's an opportunities to further grow. Now, when we think about Cintas, they've got customers right across the economic spectrum in the United States, but there's big pockets of the economy where there's still meaningful growth opportunities. Healthcare is one good example. There's lots of people in hospitals that wear uniforms, and oftentimes the way hospitals equip them with very low-cost uniforms that aren't that comfortable to wear. Those employees or doctors and nurses might be spending the day between different hospitals, and then those uniforms get lost, and that's expensive. So Cintas can generate a uniform rental program for the hospital where people feel more comfortable about the uniform they're wearing, and they don't get lost along the way. Education facilities, high schools and universities employ a lot of people that wear uniforms, and Cintas sees that as a very significant growth opportunity and all sort of leverages their existing infrastructure. And as they grow into those markets, it's very, very profitable.
And what's their balance sheet look like?
Yeah, so when we think about the capital structure, we're looking at not only what's on the balance sheet, but importantly, what's off the balance sheet as well. Now, on the balance sheet, Cintas have got net debt to EBITDA of less than 2 times. So it's very profitable. Periodically, they'll repurchase shares when they're cheap. They might find family-owned businesses that they can acquire, and that's been very, very sort of economically accretive. So it's a conservative balance sheet, but we also pay attention to what's off the balance sheet. In the case of Cintas, there's no meaningful lease obligations, which we capitalise, and there's no defined benefit pension scheme, which is very important. And so minimal off-balance sheet liabilities and a very conservative capital structure.
And in today's climate, it'd be remiss not to ask around the potential effects of coronavirus on a business like this. What's your modelling shown up for how the coronavirus could affect their operating businesses?
Well, I think this will be a durable business short term and a very resilient business long term. So in the short term, they rent uniforms, and so it's not day-to-day transactions. And so there may well be fewer of their customers that are coming to work, but they still rent uniforms on a per employee basis. Through 2009, the business remained very profitable. It's a business where, as perhaps some of their smaller competitors struggle, they'll have market share opportunities to grow into. When some of the if you like, the non-renters, the opportunity set look for ways to make their business more efficient. Cintas has got a very compelling proposition to create growth going forward. And then importantly, in times when your revenue might be down, which will probably be the case for Cintas, having that conservative capital structure helps to make the business resilient. So economically resilient, as was demonstrated 10 years ago. And this is an environment where the conservative capital structure and the ability to grow, take market share from your weaker peers, I think will really pay dividends.
And we're sticking with the social distancing initiative, so I won't shake your hand, but really appreciate you walking us through Cintas. Thanks for coming on Talkie Book.
Thank you, Chris.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.